Welcome back, and it's the final power hour of this conference. And I'm going to hand over now to Adam Sorab, who's going to chair this session. And he's the head of technical analysis at CQS Hedge Fund Management Company. And this power is called The Chart Most Likely. So over to you, Adam.
Thank you very much. Good morning, everybody. What we thought we'd try and do today is try and make it a little bit interactive. So what you're going to hear first is some very brief presentations from my colleagues here on the panel, and on covering a number of markets. And then what I was hoping to do is to have at least half of the time afterwards to allow for much more of an interactive Q&A. We have access to multiple charting technology here, so to the extent that we want to talk about other markets, I would very much encourage you to think about questions that you want to ask later on. Okay, so we've got three speakers today, three very old friends of mine, I'm very pleased to say. On my immediate right, Nicole Elliott, who for her sins went to the LSE with me, although she's a lot smarter. She studied psychology instead of wasting her time doing economics like I did, and she also got a better degree than I did, but never mind. Professional technical analyst working in the banking industry since 1982, currently working as chief technical analyst on Forex Trading TV, which in fact I took a look at yesterday. I have to say it's very good. I was quite impressed. So I encourage you to all have a look at that. Some very interesting analysis being done there. Most famous perhaps, I think, for bringing Ichimoku charting to certainly the City of London and probably to the Western world. She was very fortunate to work in the Japanese banking sector, and for the famous Harada-san at the Mizuho, and his teachings she very kindly passed on to the rest of us, and I know it's a technique that I've been using for many years. She's also a regular commentator on the media, and I think it says something for her geographical reach that she regularly publishes in both the Investors Chronicle but also the South China Morning Post. And her conversation and her presentation today is really going to focus on fixed income markets and some ideas around deleveraging in a zero-rate environment. Next, another good friend, Valérie Gestaldi from France, an MBA graduate, actually. Interestingly, did her MBA at a relatively young age and started out in the sharp end as an equity options market maker and a prop trader in France's largest stockbroking company. After doing that for several years, she went into her own consolidation phase and became a mother and a gardener. I can't imagine what breakfast time was like, but she was day trading at the same time as giving the kids breakfast, so I don't know how that worked. But now very gladly back into the profession, working for the very successful and very famous Day by Day research group in Paris, where she's senior technical analyst and a strategist. And she's going to look at the US dollar and really sort of tease out her thoughts on that in this current market environment. And then Nick Glyden, I thought I'd better get at least one man on the panel, although I really was trying to boost it with as many women as possible so we could have some really solid ideas without any excess emotion. But the emotional Nick Glyden, who interestingly is a microbiologist and a geneticist by training. So if anybody's got any questions on Ebola, he's your man. He got started in 1986. Interestingly, started out, like a lot of people in the 80s, drawing handwritten charts, originally at Kleinwurz for Steve Jarvis. He was one of the famous Value and Momentum team that started out at Credit Lyonnais, went on to Fleming's and then JP Morgan. Interestingly, he tells me about Fleming's. It was a really great place to work, apart from the bagpipes playing every morning. But I don't know about the bagpipes, but certainly was a very successful research group and very successful trading team. Founded Redbound Partners in 2003 with a handful of colleagues. He's very successfully grown that into a 160-strong trading and research group. And his conversation today is going to focus on the FTSE and more broadly, I guess, on equity markets. And so hopefully we're going to be able to cover the whole waterfront. And as I said, we will have time for questions afterwards. What I would ask is, really in light of the kind of regulatory environment in which we work, we'd much rather, to the extent there are questions, we want to focus on current markets. Let's focus on indices, commodities, foreign exchange, those kind of broader things, rather than getting down into single stocks. But with that, I think I'll invite Nicole to kick off the proceedings. Thank you.
Hope you can all hear me. I'm going to rattle through this at a really fast pace. I've only got 3 charts. and I've kept them as simple as I possibly can, deliberately so. I can see it's a very long, thin room, this, isn't it? I do hope you can see them clearly. And I'm focusing on interest rates. I think this is absolutely key to the global environment, not only today, but over the last sort of decade or more. So kicking off, I've got the yield on the benchmark 10-year German government bond. On the left-hand side of the chart, we start off just after 1990, post-unification Germany, with a high of 8%. This is a decade after yields in the States and the UK peaked, so that's quite significant. You've got a bit of a shift there. We started off counting this in Deutschmarks, organised by the Bundesbank. It then morphed into a euro overseen by the ECB, and from the sick man of Europe, it turned into its powerhouse. So here you have it, a quarter century of a descending channel towards lower interest rates, and now we are under 1%. Now, this is not just a trend channel. This is a DNA trend, isn't it? It's absolutely much, much more steady than a heartbeat. It really is quite something. Now, many say it's in a bubble territory, particularly following the steeper decline in yields that we've had since 2008. Now, these are probably the same people that keep telling me that it's in bubble territory and I'm not to buy fixed income paper, and they've been telling me this for 5 consecutive years. The way I see this, there's absolutely nothing erratic about this trend, neither the little one nor the broad one. We are, yes, at record lows, but record low does not mean to say rock bottom. What is rock bottom? Well, this is the big question. I think this is what we're really going to have to start facing up to over the next year or so. We know that real interest rates can go negative. We've seen our money confiscated time and time again, courtesy of inflation, haven't we? The new thing now is that we have negative nominal yields. I never thought I'd see this. I thought it would be a one-off. It's not a one-off, is it? We've got the Schatz, the German 2-year, at minus 0.6%, Swiss 2-year at minus 0.8%, and at the ECB, if you want to park your money there and keep it out of the European banking system, they're going to confiscate 20 basis points from you. The other thing they say is, oh, well, I don't really want to tie up my money for 10 years. Well, you're not tying up your money for 10 years. This is one of the most liquid, cheap instruments to trade in the world. I can turn it around just like that. It's fantastic collateral. I can repo it out time and time again, and it costs nothing. So I'm not tying it up. But what I can do is save myself my 20 basis points at the ECB, earn about 90 basis points here, and as soon as it looks a little bit smelly, I just sell it out and off we go. The other thing to point on this one, and this is my final point, oh, by the way, my target on this is 45 basis points, by the way. And the reason I say this is I think this should be yielding what Swiss 10-year does and Japanese 10-year does already, 45 basis points. So in other words, yields have still got another 50% to go from current levels. The other thing to consider, in a potentially deflationary environment, are negative nominal yields the way to compensate for the fact that money tomorrow is worth more than money today? My second chart, I'm going to speed it up a bit. Have we got that one there? There we go. Now, this is the spread between US 10-year and 2-year Treasury yields, okay? Again, going back to the 1990s, 2s, 10s in the jargon. You'll see that nearly all of the time it trades above 0, okay? 3 times we've gone inverted. That was 1990, 2000, and 2007, at times of extreme financial stress. I think what's far more interesting is that it's capped at the top Is this the right chart? No, it's not the right chart, is it? Oh dear, what's gone wrong here? Well, let's go on to the next one. But anyway, 2s, 10s, just to come back to that. We've got a bit of a nightmare here. We've got sizing all wrong. Not to worry. This should be the JGB yield. Yes, it is. In 1990, they yielded 8%. Terribly sorry about this, folks. In 1990, they too yielded 8% and then collapsed down to sub 1% as the Nikkei collapsed too. Since then, they've troughed in 2003 at 45 basis points, again caused by the banking crisis in Japan, when they were all bailed out. Since then, you've hovered between 45 basis points and 2%, i.e. pretty low, steadily low, in fact incredibly low, 16 years of flatlining, and I call it like a patient etherized upon a table. Lesson number 1, things don't necessarily recover. Lesson number 2, the central bank can set their rates, but the fixed income market does whatever it wants. There's a wonderful simile in Japan where they describe the yield curve as being like a fish, a big fish caught on a hook, on a fishing line. And the head is firmly anchored on the hook, and the tail can flip around as much as it wants. And I don't care what Mr. Draghi's got to say. I've got my own ideas of where interest rates should be. So there we have it. And the reason I suggest that the bunds, as I say, this one is going to just flatline. I mean, there's no point. There's no point getting exciting or doing something too much about JGB, right? And it reflects negligible or negative inflation that has been the case for all too long in Japan. There we go. Sorry about the charts, folks.
Good morning, everyone. Even though we are under pressure to deliver in a very short time, I will just take a minute to say that back in 1985, when I got my first job, I was, on the first day, I was handed $500,000 on a CBOT account to shop for options. And a value line book for the eldest ones here. It was a fundamental analysis book with plenty of sheets, fact sheets on 1,000 US companies, and technical analysis explained by John Murphy. And believe it or not, I thought that technical analysis explained was a lot more useful than value line to shop for options. And this is what, it was a whole career that started there because of that book. And there were a few other books that have been very, very important in shaping my knowledge. And those were Bob Prester, what was it, The Tidal Way or something like that, the Blue Book. And then came Alexander Elder. And the next stepstone was Tony Plummer. And they are all here today, or they have been here, and I cannot say how thankful I am to the four of you, because without you, I wouldn't be here. And also, every day when the going gets tough, and when I doubt about my own analysis about the market, I can go back to what you have written, and I think, okay, I may be wrong, but if I apply the method that they have given, nothing really bad can happen to me. So as an analyst, because today I act as an analyst, I think it is very important to have a method and a strong method. So having masters is something that is really helpful to go on every day when it's really tough. So to go to the forecasting part, which, I'm right when I forecast about one side of twice. So hopefully this will be a good call. But I was required to talk also about DNA, market DNA. So I thought that I would choose something that is really at the core of all markets, and that's the dollar. And actually, it's very interesting because, you know, the dollar chart really looks like a DNA chart to me. And this is maybe a dollar that you're not used to because it's the dollar index, trade-weighted dollar index, as it is calculated by the Bank of England, and it starts in 1975. So this is the chart that we will be looking at to begin with, and my forecast is that we will live in a world with a strong dollar until at least 2018, and I'll explain you why. So this is the dollar index chart, and for a long time I've been sitting at, you know, watching the chart, waiting for ideas to emerge for many years. But then one day, that's the magic of technical analysis, everything became clear because I drew certain lines, and those lines, you know, make it a lot easier to understand. And I'm going to show you the lines that matter on this chart. So I thought there's an uptrend to start with. You know, there's a major bottom in 1978. It rises into a top in 1985. I can see there's also a major bottom in 1995, rising into a top into 2002. What is also obvious is that 1985 to 1988 is a major bear. 2002 to 2005 is a major bear. So what I'm left with are two periods that are, you know, ranges, one from 88 to 95, and another one that started in 2005, and my projection has been for already several years that it would end in 2012, roughly. So what I was expecting was somewhere in mid-2011 to 2012, I had to wait for a while, a new rally on the dollar. So this may look like chance because we don't have much history, you know, whether the dollar is going to rise into 2018 or not. But that was a starting point. And I thought, okay, if you think that about the dollar, you can check what the euro looks like, because obviously they have to balance each other. The other currencies, when you look at trade-weighted indices, the other currencies are far less important. So let's check the euro. And the euro is really a very, very easy chart because it is the Dutch mark previously, and you know how regular and easy to forecast the German are. They are very robust. And this chart, I think, is very robust too. Now that I've drawn my arrows, can you see how easy it is? You have a top in 1975, a bottom in 1985, a top in 1992, a bottom in 2002, and a top in 2009. So that's 17 years every time between each tops and bottoms. Very basic, but okay, so I expect another bottom in 2019 because they're always spread by 17 years. So for a long time I thought, okay, you know, you've put numbers around, but why do things move like this? Also remember, I'm not a trader anymore. I am an analyst and I have to sell stories. If I don't have very strong elements to convince people about what I say, they're not going to pay as much. If I just tell a stop loss, they think they can do it themselves. So I have to give them a story that they can come up with themselves. So as I said, I am one of Tony Plummer's best fans. And I work also on his method on long-term cycles. And this is the CPI cycle, long-term cycle. And, well, more or less, that's the one-way rate of change as he exposed earlier. This is what it looks like over years. That's the standard CPI cycle. But the latest CPI cycle that ended in 2002 and started roughly after the war is in red on this chart, and this is what it looks like. And there are very important timings in the cycle. It's the two intermediate lows that happen roughly 33% into the cycle and 66% into the cycle. They are not perfectly on time, but that's roughly when they happen. And over the previous Kondratiev cycle, those two bottoms happened in 1964 and in 1986. And the cycle, as I said, ended in 2002. And the new cycle that started in 2002 is supposed to end in 2019, 2020. Well, to end, not to end. We will have a first very low point, so a deflationary period for the US economy possibly in 2019, 2020. So now that I knew all those dates, and I just did a little homework, and I'm going to show you this homework. With all those charts, I mentioned a number of dates, and those are all the dates that matter for the dollar, for the euro, and for CPI. So we said that we had a euro high in 1975. We said we had a euro low in 1985. Euro high, euro low. They are on this timeline. Where are the dollar highs and lows? So dollar low is 1978, 1995, 2011. Dollar high, 1985, 2002, and my assumption is around 2018. Well, my first assumption was around 2018. And then where are the major CPI low that come up, from the CPI analysis? Major CPI low were 1985, 2002, and I expect the next one to be in roughly 2019. So this is taking shape a little bit. And if you check the relations, you can see that there are 10 years every time between each euro high and low. There are 17 years between each euro highs. There are 17 years between each euro lows. And there are 3 years between a euro high and a dollar low. And there are 17 years between each of those CPI lows. So, it all ties together. So maybe my forecast has a little more than a 50% chance of being right. And I can also, what's nice is that I can also, once all those charts are tied together, I have a sort of stop loss for analysis. It's that all those charts will have to make sense together in the future. In order to get the dollar high, I will need to have a CPI low, I will need to have a euro low, and this will help me improve my timing in the future. So also, I know that usually CPI lows are spread apart by 18 years and not 17. So I am ready to wait possibly for a little longer than 2018, and possibly the dollar high will come in 2019 or 2020. I'm open. It's, my window is from 2018 to 2020. So, I wanted to share this point of view with you. I think it's going to be a very important part of my own analysis in understanding markets in the coming years, and maybe you will be able to make use of it too. So thank you for your attention.
Okay, my name's Nick Glyden. I'm a European equity analyst. Just look at charts. I don't believe in fundamental analysis at all. This is a chart of the FTSE 100 going back to 1996. We've made no progress whatsoever in the UK since 1999. The peak was 6,950 in 1999. I've been working for a stockbroking firm all the way through all of these, and let me tell you, it's not been much fun. It was fun in 96, 97, 98, but since then, pretty dull, I have to say. Not dull's the wrong word, sorry, pretty unrewarding, I think, for stockbrokers. That hasn't stopped me being a natural bull. I have to confess I do have an inbuilt bias. Being a stockbroker, you've either got to be a massive natural bear, like someone like Albert Edwards, or you have to be, I believe, a natural bull. So I do know about my inbuilt bias here, so apologies. But my feeling is Sorry, feeling is probably not a good word to use, is it? My view is that if this does break out above the 7,000 level, that this is a massive consolidation. Obviously, I haven't showed the chart before this, but it came from the bottom of the floor. So this is a sideways move after a massive 1980s bull market, sideways for 15 years, and I believe preparing to break out. After Robin's talk with the market profile, I did just check this out. I suddenly wanted to check that there wasn't some gap in the market profile bell curve, and there isn't. So I don't think this has got to go down a long way to fill in any gap. I think this is poised to break out. And remember, I'm talking long-term, not short-term. The short-term outlook on the FTSE isn't quite so lovely. But I think we have to remember that I don't think we should be surprised that the market's running into a little bit of trouble at this level, because look how important a resistance level it is. It's exactly where we stopped in 1999 and 2007. So I believe it's very natural for the market to be having a little bit of a setback at this stage. But when it breaks, I believe it's going to be an enormous breakout. Now, when I say enormous, I don't mean that lightly. I think I've always sort of been brought up to believe that if you've had a 15-year consolidation, when it breaks out, or say 15-day or 15-week consolidation, the breakout will be either 5 or 10. So I'm roughly using sort of Fibonacci levels, really. So I would believe a 15-day breakout, you'd see 5 days very sharp up or 10 days very sharp up. So I'm saying this is going to go up for the next 5 years once we're through this little shakeout we're at the moment. If you do this on a point and figure chart, of course, it all crams up into lovely columns, and the count, the way that I do it, which is slightly more Wyckoff than traditional point and figure, the count is for 20,000 as the target for FTSE. So I'm going to stand by that for now. My FTSE target is 20,000 in 5 years' time. Hopefully that's bullish enough for most of you. Don't get me wrong there, I'm not saying the UK is a great place in the world. It's pretty disastrous, frankly. This is the MSCI UK against MSCI World. We are making this is a very long-term chart, back to the 70s. You remember how horrible it was in the 70s. I should just say this is the ratio of the two. This is what I do for a living, is I look at ratios between stock prices and an index, or one index and another. So I'm trading relative strength. This is a relative strength chart. You can see the UK looks pretty terrible against the world, breaking down to a multi-decade low. In the short term, actually, there's some signs of a small base forming. You can't see it on this chart. But I'm not saying anything particularly positive about the UK relative to the rest of the world. So I kind of think if the UK goes to 20,000, I should make up some Dow target, but I'm not going to. The Dow's probably still going to outperform the FTSE. And what's going to be the best stock in the UK? Everybody hates the banks. I kind of like the fact that everybody hates the banks, because although I'm naturally bullish, I'm slightly contrarian very, very long term. I'm never contrarian short term, but very long term I like it if everyone thinks I'm crazy. This is Royal Bank of Scotland relative to the UK index, using the all share here. Again, a long-term chart. The current level, it's not just a 10th of where it used to be, it's a 20th of where it used to be relative to the UK market. This isn't an enterprise value chart, this isn't a market cap chart, this is price relative. So the fundamental analyst would say, well, look, it's never going to get back up there again. But I kind of like it when people say it's never going to get back up there again. Anyway, the key thing is, nice sideways move, triangle pattern, trend lines all working pretty nicely. It's now it's very nearly a 12-month relative high. It's actually an 11-month relative high. That's kind of good enough for me to say it's a confirmed breakout to the upside, and what a beautiful triangle pattern. So I don't know if I'm allowed to give actual stock recommendations, but this is the kind of thing I like. Target isn't for it to quadruple, but certainly a doubler. That's it from me.
Okay, perfect, and nicely on the half an hour slot. So we have 30 minutes for questions. What I was going to suggest is, to the extent you've got questions on any of the things that you've heard, please put your hands up and fire them in. And to the extent you want to broaden the conversation and ask about other markets, I know we'd be very happy to address that too. Axel.
Nick, you just said we could have a correction in the short term. How far do you see that going? Do you look at that?
I'm actually not as bearish short term as everyone else is. Part of the problem is if we look at the DAX has broken. So the DAX has broken below its August lows. I don't think that's the most important index to look at in Europe. I think the Euro Stoxx 50 is. Let's face it, that's the one where the futures traders are. That has not broken. Okay, it's not looking great. Volume's picked up on this decline. It is actually, though, just holding above the August low. And it might be my natural bullish bias is making me look at the charts that aren't as bad as the others. And I have to confess that, you know, whilst the Russell's been collapsing, I've been saying, this is not the market. The Russell is small, flipping micro-cap stocks. It is not the market. So I will confess that I have not been as bearish as everyone else. Everyone else has been saying, oh, the Russell's all that I care about. I've kind of been saying, look, if the S&P breaks that 1903 level, which is the August low, then I have to admit that's a top pattern. But my short-term view actually is 1903 has held, the Euro Stoxx 50 has held, FTSE and the DAX, I agree, look pretty bad. The Russell, I agree, looks terrible, but let's face it, everyone knows that. So actually, sticking my neck out, I think this correction's over. Maybe one more down day on Monday, but if we have that, I would be pretty keen on a turnaround Tuesday kind of thing. So I don't want to be really bearish, but at all. And that's not just my in-belt bias. Over to people who are less bullish, perhaps. Anyone want me to put another one up here to answer that question?
Anybody you guys want to come in on that?
Anything?
I think the markets are going to be much more differentiated over the next few years. So, by geography, I'd really split them into, do you know what I mean, the sort of up-and-comings, the Southeast Asia, I think, is looking far more bullish than anything in Europe. And I think the US is terribly expensive at the moment. So I wouldn't lump all the indices together at all, no.
So this is Shanghai Composite. Hands up if you think that's a downtrend. Yeah, it's not a downtrend, is it? Yeah.
Yeah, put it on a longer chart.
No. Good call. Yeah, good call. It's a sideways thing. Yeah, but it's interesting, isn't it? You know, everyone says, oh, you know, China's a disaster. Well, it's had its disaster. The disaster was 2007-8. It's gone sideways since then. So I find it very hard to be bearish about a chart that looks like that. You may argue that the Hang Seng is perhaps more relevant, and to me that's not a good-looking chart. So, P ratios. Jesus. Okay, hands up. Who likes P ratios? No, sorry. I know I'm in a slightly biased environment here, but my view on stocks and P ratios is your job is, if it's going up, you should own it. Don't tell me what the P is. If it's going down, you should be short it. That's my personal view is you actually make more money in high P stocks. Particularly, actually, there was someone talking about management meetings with management. I really liked. Someone said that they're pointless. And I actually think it's quite nice to meet the management, because if you know that they're crooked, you've really got a massive... You should be long, obviously, because if they're crooked, they can make the stock price double much quicker than someone who's telling the truth. So, and also, but most importantly, as soon as the chart rolls over and breaks your stop loss level, you are out of there. Whereas the reason I think most technical analysts lose money, once they're in a stock that's quadrupled, they've got their stop loss and it breaks the stop loss. But it's a great management. They've quadrupled my stock. You know, they'll turn it around and they'd forget to use their stop losses if you believe the management are wonderful. So much better to ignore P ratios, invest in companies where you know the management are crooks, but use your stop loss. I should probably sit down now. I'm done.
Let's
Anyone else want
let's
to
have, no, let's have another question, I was going to say. Tim.
Nicole, I enjoyed your view on the Bund yield. Where do you see other European bond yields, such as the BTP and the Bono? Do you see that those spreads to Bunds tightening further?
Yeah, indeed. I think one of the things that people forget is that usually measure these as a spread, but what you should be doing now is measuring them as a ratio. Yeah? So, for example, the, I don't know, BTP yields 2.5 times Bund. So does Spain, roughly. Yeah? 10-year.
This is spread, not ratio.
Yeah,
sorry.
but you see, that's my point.
Yeah.
My point is, it's the ratio. Basically, Italy and Spain are absolutely scuppered if they've got to borrow money at 2.5 times Germany. They're never going to catch up. Never. Do you know what I mean? It's just hopeless. So something's got to be done there. I can see Draghi's problem. And as I say, most of the sovereign paper is really easy to trade, yeah? The other thing as a bank, as a banker, as an ex-banker, may I say, is I'm not going to get 20 basis points slapped off me, courtesy of the ECB. I am just not going to do it. That gives me 20 basis points of leeway, so I can pile into anything that yields more. Yeah? I've got 20 basis points there to play with. Bob's your uncle. It's obvious. It's absolutely obvious. The next one I was going to say, and unfortunately my 2s10s chart went all wrong, is that this is the situation in the States. This is what should be happening in the States. US Treasuries 10-year at 2.3% currently yield 2.5 times Bund. In a global market, all you've got to think about is the currency exposure, which is dead easy to hedge. Yeah? So that's why I think 2s10s is going to really narrow in, and it should start trading at, my target is 30 basis points. And if my US 2-year is going to be at about 50 basis points, my target for US 10-year is 80 basis points.
I've managed to get, that's German yield divided by Spanish yield, or other way around. It's, yes, so the Spanish yield is 0.4, German yield is 0.4 times German.
It's a whopping difference. It's a whopping great big difference, isn't it? And again, this is where we've got to start using ratios more, because when all our prices get towards zero, yeah, whether it's a commodity, whether it's corn that the gentleman was mentioning, do you know what I mean? When your prices are getting towards zero, the maths must adapt. Yeah?
Another question.
Yes, I have a question for the second speaker on the Japanese yen. What's your view for yen versus dollar and the yen versus euro? So in terms of both, say, direction, how much further it can weak against US dollar, and when will be the next turning point? And also, I'm also quite interested to know why, just as you explained about CPI in the previous slide. Thank you.
Why not the US dollar?
Yeah.
Thank you for your question. Although I don't have the charts of the trade-weighted US yen with me, so I can't show you. I have a target, and I think it has moved already. But my target must be the equivalent, more or less, of 120 on US yen. So that will be maybe another 7-8% down for the yen. But I haven't cracked any specific pattern to the yen yet. Maybe I will find one later. You know, I've got one for the dollar and for the euro. I don't know what moves the yen up to now. I'm doing research on the Japanese economy, but there is not enough data to have strong conclusions on the really long term. But you know, looking at a standard US dollar against yen, this chart, you know, we had a breakout after a long consolidation, and it should be rising further, and then you can start laying your Fibonacci retracements over the very long term and so on. So if you can draw the 120 target, maybe?
Yes, so 120's up here.
So that will be my first target. It should go, the dollar should rise further against the yen in time, but just follow the trend. You got the reversal levels. I don't know how to set targets with technical analysis. There are pattern targets, but pattern targets always fall short of the end target. So it's so easy when you have a trend. You just have to rely on the definition of what a bullish trend is and pick your last low in the trend, and that's your stop loss. And you hold on to your trade until you're stopped. And there's no comment to do in a trend. I can only speak when there are reversals. This is where I add value. The rest is, you can leave it to a machine, really. So as to euro-yen, so we have two competing very weak currencies. Who's going to win the game? Right now, there is no clear indications. It's just, going sideways. And what can I say? There's a little more upside potential for the euro versus the yen, potentially. But this is not a cross that I would put forward into any roadmap that I will put to my clients. You shouldn't be trading that spread because the two currencies are, both of them, much too weak. So it's better to have fun on emerging market currencies or things like that than euro-yen.
Just on the yen-dollar, 120 is also the Fibonacci retracement of the decline from 98 to 2011. 120 makes sense to me. It's a bit consensus there. Is it a bit consensus, 120 target?
In the heart of the trend, everybody's right, so we don't worry about the consensus.
Let's have another question.
Am I allowed to broaden the matters under discussion out? Does anybody look at GAN numbers? Because 7,200 on the FTSE would be, to me, a clear multiple of the compass of 360 degrees.
Anybody here GAN fans?
I read a lot about GAN when I was younger, but I don't use it currently. The only thing that the S&P peak, obviously, recently at 2000 was exactly 3 times the 666. Well, I think the 666 low might have been some kind of GAN number, but also obviously exact tripling from the low on the S&P when it hit that did send little alarm bells. But I haven't looked at cardinal, the square numbers. I haven't done that for a long time, I'm afraid. Part of the problem, of course, is there's so many indices these days. Do you do it on the Bob Beckman book was brilliant on the FT30. So it's Elliott wave rather than GAN, but this is a problem we have with analysis of actual numbers these days. There's so many indices. Is the Dow more important than the S&P? Is the FTSE more important than the all-share? Will we soon be switching to just using the ETFs? Instead of watching the Nikkei, will we watch EWJ and that wisdom tree one that John was talking about? So trying to find exact levels using GAN squares, I think you've got to know which index you want to concentrate on.
Anyone else want to say that again?
Well, I think GAN is very useful when you have IPOs because as technical analysts, we cannot comment on IPOs, but you know that whether you're going to halve the price or you're going to double it. That's my that's my very specific use of GAN.
Yeah.
Nicole? Another question. Yes.
The dollar bull market is clearly pretty negative for the developing world. From the EM equity space or EMFX, which currencies look most bearish? And on the other side, are there any economies that can survive this outcome?
I'll just put the Russian ruble up for you.
We'll put our resident bull on this case. Yeah?
This is an amazing chart. Look, so going up obviously is dollar strength. I just love the way that this broke out here. I can't remember the level, 37 point something. Failed breakout first time, second time wasn't. Anyone else?
I was just going to say generally about currency markets at the moment. Many politicians and central bankers have a policy of a rush to the bottom. They want their currencies weaker. Yeah? It's a way of getting out of deflation. It's a way of increasing your exports, yada, yada, yada. So quite frankly, I can see this all kicking off again, and I think it's started already. I mean, the ruble is a bit of an exception. It is a managed exchange rate. Do be careful with this one. And yes, it's got specific problems there, bigger than most of the other emerging markets have at the moment. But you are seeing the other ones that are very weak at the moment. The Indonesian rupiah looks as if it's about to break out of something like a 25-year straitjacket. And I think, you know, is it a good thing? Is it a bad thing? Well, it depends on where you're coming from, what you're trying to achieve. But certainly I think that the euro, ironically, in its favour, has deflation. That's a plus for the euro, yeah? So it's not so clear at the moment, and I just think an awful lot of emerging market currencies are looking very precarious right now.
I was going to add to that. I mean, I think the Chinese renminbi is a very interesting currency relationship for us to keep an eye on over the next few years. That seems to have started to sort of move out of trend as well. I don't know if you can put a CNY chart up.
Yeah, sorry, what do you want?
The Chinese renminbi?
CNH or CNY?
We'll see. N for nodding.
Sorry, yeah, that's typo.
Usually longer term than that.
Longer term. Okay, that's back to 99. Here we go.
And the real question, I think, is, you know, is that are they going to let that currency devalue over the next 4 to 5 years, or is this thing just going to carry on going, right? And I know it's not something that people can easily trade, but I do think it's probably going to be something that's worth watching.
This is the JP Morgan Emerging Markets Currency Index. It did break a few weeks ago, and our target's another 4% down. Yeah. Well, this is emerging markets relative to, oh wait, you can see I've got rather a lot of trend lines on that one. This is emerging markets relative to the, you can see I watch this a lot. Emerging markets relative to the world. Is it bouncing at a support level here? I kind of think it is, but I nearly used the word hope there, actually. I nearly said I hope it is, and that's always bad, isn't it? But I think it's at a support level. But I can't believe I said hope. It's disaster. Yes, four-letter word, yeah.
Another question.
Hello, Nick. I wondered if you wanted to look at the oil chart, and if you're bullish of that, then go to a doctor.
Yeah. Okay, my natural inbuilt bullishness does not apply to commodities,
Surely it
but
doesn't stretch
it's
to
only to equity markets and equity market volumes. That's what I know. Okay.
But obviously, and the other thing, obviously, with oil and gold being quite beaten up, yeah, it'd be interesting if the panel's got any views on how they think that could affect everything else.
Okay, I have a slight problem with oil in that I don't really know if this 2012 low is real or not. It depends how you do the rollover for the futures contracts. This is WTI, but if I do it for Brent, you'll see that we kind of touched it this week. So yeah, this is the 2000, and this is the way that everyone who uses Bloomberg looks at it. But I'm told that this low has been broken if you do contiguous rather than continuous contracts. The updater guys are the people to speak to about this. When I look at this chart, I go, it's definitely not a down. I mean, so it's definitely not an uptrend. It is a downtrend, but is it holding at a support level? I do, however, I know I'm not very good at oil particularly.
Why don't you call up spot prices?
Yes, it's called USCR something, isn't it? See, here we go. This one. That's a good point. Right. So this is US spot.
That's it.
That's not broken. The other one that I do quite like is this is an interesting chart. This is US petrol at the pumps. In fact, someone put this chart up earlier on in the week, and that does look like a top pattern building to me. That looks like a big head and shoulders top, but obviously it's not broken. But the petrol price could be about to break lower. I haven't answered your question. I don't know is the answer on oil. Sorry. Sorry. Quick answer.
I have a view.
Oh, you have a view. Thank you.
Well, short term, I mean, short term is so tactical in those markets that it's not the point here. But if you look at the trend, which really looks very, very heavy, and if you think about the CPI chart, where it's really promising that we will not see any inflation and we are heading into deflation, well, you know, you can wait for as long as possible until you fill up the tank, and you know, every time, because they are doomed to go down, oil prices. We will have the occasional bounce because of geopolitical geopolitical reasons, but in terms of demand, I think that all charts are pointing down, and we have no element to say that it's over. So, you know, follow the trend once again, and sell all the bounces for the time being and for a few more years.
I would also like to add that let's not forget that most wholesale commodity markets are priced in US dollars.
On top of it,
so if Valerie is correct and the dollar is going to strengthen by another whatever, 10, 15, 20%, every commodity price should lose 10, 15, 20%. Ergo, end of, right? So it's not necessarily oil that's good or bad. I'd also like to point out that in the very long-term charts that Nick brought up, and you can see it there, you had this ridiculous rally in whatever it was, 07, 08, and all the rest of it. And do you know what I mean? And what we're doing, we're in a holding pattern for crude, both Brent and the wholesale gasoline and the NYMEX. Okay, so you're actually in a holding pattern, a very, very giant symmetrical triangle. And I don't know about you, but I don't consider $90 a barrel cheap.
Here's your triangle, I guess. This sort of thing. It's broken.
But triangles are tricky.
Let's have another question. This is good. Let's keep it moving. Over there. Yeah.
Hi, Nicole. In terms of your target for T-notes, down to 0.8, I don't really quite want to think about what the US economy is doing at that point. So a couple of questions. Does your view of stocks and the dollar tie up with that thought process? And in terms of the twos, tens flattening, what do you need to see that it would actually be the twos outperforming in yield terms that would drive the flattening? So the alternative, opposite view.
Could you repeat the second part, please?
So the first part is if 10 years are going to yields will be at 0.8, so significantly lower than where we are now. Does that tie up with your S&P and dollar view, and what would they be? And the second question is, what do you need to see that you would actually get 2-year yields driving higher and outperforming that would drive the flattening of the curve?
Thank you. In terms of my view on stocks, US indices are more cushioned than some of the others. Okay, so if we're going to go into a bear market, and I think we are, the US indices will lag and drop by less. Okay, they have a safe haven type status embedded in them. There's like an option in there, yeah? There's a bit of optionality in there. But I do think that too many indices are too expensive at the moment. In terms of the yield curve, I know my view on the treasuries is totally out of kilter from everything you've been hearing from, you know, but I view the US economy as far more fragile than most people are currently thinking it is. I do think that some members of the Federal Reserve are aware of this, and many central bankers have at last learned that A, they are not God, and B, they've got a really, really difficult, long task ahead of them. This is a very serious, long-term problem, and it's all to do with too much debt. And this debt has got to be got rid of one way or another. And there are three ways to do it. The neat way and the hard work way, which is paid off in tiny installments. So you've got to have rock bottom interest rates forever. The other way to do it is just walk away. And I think there are an awful lot of people in Europe and the States who will walk away from money they've borrowed. There's a lot more coming still. Yeah? And finally, the other way to do it is just to declare yourself bankrupt, which really hits hard in the banking sector. Yeah? One way or another, the financial sector is very fragile indeed still, and I think it's going to take another 10 years for it to sort itself out.
Another question. Yes.
Hi, it's a question for Nick. You've shown the FTSE is likely to underperform other indices. Do you have any view on what other European index would actually be leading within the Europe?
Sorry,
sorry?
Is the question, is there a European index I think is going to outperform?
No, which in Europe, where the leadership could come within Europe, you know, if somebody wants to invest in Europe. And secondly, what do you think on DAX relative trend compared to the within a major European index? Is it rolling over?
Yeah, the DAX is underperforming at the moment. This is DAX relative to Europe here. So it's been a big winner over the last 10 years. It's now broken down relative. I think actually, I haven't checked this in the last few days, but yeah, I kind of think maybe Spain looks pretty good. France doesn't. I mean, actually, FTSE doesn't look bad relative to Europe. Europe looks so bad that actually, you know, even that's not a great chart. I know, it's not going to be this either, is it? This is Greece relative to Europe. That's not going to be good. No, it's not. It's not a disaster.
You're not struggling then?
I'm struggling, yeah, here we go. Ireland.
Switzerland.
Ireland. Yeah, so Switzerland is the answer, actually.
Well, it's a currency play, but Switzerland and the UK should outperform in the coming years.
This is Switzerland relative to Europe. And if you look at the biggest stock... Oh, I'm not allowed to do stock names. Sorry. Biggest stock in Switzerland's making relative highs. I don't think UK looks that bad relative to Europe is the quick answer. Yeah.
We've got time for some more questions if you want to ask across other markets, or if you want to ask more broader, more tangential questions around techniques, you name it. Yeah.
We haven't done a poll of who's bullish and bearish.
I'll do that at the
Have
end.
you looked much at the long end of the JGB curve? It seems to me it's quite interesting, 10s versus 30s, and given obviously the policy. But let's just focus on the chart here, what your thoughts are on a 10-30s curve in JGBs.
I tend to focus on the 10-year in Japan because it's so much more liquid, and the 30-year is very much more a niche market. So, do you know what I mean? If you wanted to take the DNA, stick to the 10s, and then see the 30-year as being sort of, you know, the slightly skittish one or whatever. But what's also happening in certain fixed income markets is you've got total lack of supply now. I mean, it's ironic, isn't it? You've got massive of supply, and yet it's all locked up. So, I mean, how much are they buying every month? I don't even know. I mean, it's just ludicrous, isn't it? And all of those will be, I'm certain, held to maturity, because the central bank won't dare sell them out before maturity, just in case they have to take a loss. Yeah? So all this paper is going to be locked up. And the market, you can see it, particularly in the US already, where the repos are failing all the time, massive, just terrible failures all the time, where certain issues are in such short supply that the rates just go out the window. And so the market is really creaking, and I think this will get worse rather than better. So when you see a market that's very much subject to shortages and obviously then squeezes, take it all with a big pinch of salt. Yeah, plenty of wide parameters, I would suggest. And the 30-year is one of those issues in Japan, I say.
Okay, so we've just got a very little bit of time at the end, and what I thought we'd do, we thought we'd run a poll and ask you across the three main asset classes we've been looking at. And what I'd like to do is have everybody who thinks, we're going to cover 10-year yields, we're going to cover the dollar, and we're going to cover the stock market as defined by the FTSE 100. The main stock market of the world, as we all know. So perhaps you could put your hands up if you think 10-year yields over the next year will be higher than where they are now.
Oh, I shouldn't do this, should I?
Okay. And if you think they'll be lower than where they are now. So I think that's probably, to be fair, I think that's probably a 40-60 in favor of lower, right? Okay, let me just write this down, otherwise. FTSE 100. Hands up if you think it's going to be higher than where it is now in a year's time.
In a year. Yeah, me too.
And if you think it's going to be lower? Again, I would...
50-50.
I'd say that was 50-50. Interesting, isn't it? Yeah. Okay. And then sounds like we've got a bunch of economists in.
Do you want to do the S?
And the US dollar, as defined by the dollar index. Higher over the next 12 months? Ooh. Oh dear, dangerous. Consensus trade. And lower? Okay. The Tom DeMarc man in the middle. Thank you very much. Okay, I think that's probably 90-10, would you say?
99.
Yeah. Okay, well, what I promise to do is I'll make a record of these, and at the next IFTA conference in Tokyo, we can remind ourselves of just how prescient we all were.
Got to call my currency broker and son.
Again, without saying, I'd like to thank very much the panelists for joining me today, and wish everybody on the panel and indeed in front of us good luck over the next year trading, and thanks very much for listening.
Yeah.